Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the August investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the market universe that we think you need to know right now. Bob, welcome back to Wealthy Behavior.
Thank you, Sammy.
So we have a few things that we wanted to tee up, some of it based on headlines, and I think things that either we're thinking about or that clients are asking, and some of it just, I think, the periodic updates that we do when we talk about investments. So why don't we start with that latter group? How are the markets doing? If people have been enjoying their summer and not watching it day in and day out like you are, what would they be surprised to see?
Yeah, I'll just run through some index returns, looking at the trailing 1 month and year to date. So the MSCI USA, so think of this as US large cap stocks, last 1 month up 0.41%, and year to date up 7.83%. So pretty solid year for US stocks. Looking overseas, developed international equity, the MSCI World ex USA, last 1 month down 73 basis points, so negative 0.73. But for the year to date, up 18.25%. So over 10% better than US stocks. And then looking at emerging markets, MSCI emerging markets, 1 month is 1.36% positive, so good month. And year to date, up 17.83%. So strong year to date return for emerging market equities. So on the whole, equities are doing great year to date if you take a global approach, which we do. And then looking at bonds, the Bloomberg US Aggregate Bond Index was up 1.15% last month. So for the month, up over 1%. And the year-to-date total return on the Bloomberg Ag is 4.76%. So how do you get 4.76 year-to-date and over 1% in a month in investment-grade bonds? That means interest rates have declined both year-to-date and most of it coming last month. So you've seen some price appreciation in core fixed income. So that's a quick run through of global stocks and US bonds. So overall, it's been a great year for investors.
Yeah, absolutely. And I think a little bit of a hiccup, as we talked about in the moment in April, but for the most part, I would say it's been a lower volatility year, right, than you'd expect since then.
Yeah, with the exception of the April
Yeah.
hiccup, it's been yeah, I mean the last couple of months have been pretty smooth. There's headlines all the time that you might expect the markets to react more to, but they've been pretty immune to it, and it's been a steady ride up.
So we've talked in the past about valuations and just how to kind of value either an individual stock or how to value a market. And one of the topics that we had for today was looking at a specific valuation metric that I would say at points in my career has gotten a lot of attention and caused a lot of consternation. And then lately, my question to you was, it feels like people aren't talking about it as much anymore, and that's the CAPE ratio. But before we get there, maybe you can kind of tee up valuations, PE, and what's different about CAPE, and then we can go into kind of what happened to it.
Yeah, so this will be a little bit of a technical segment, but it'll be interesting. So for some people, when you look at stocks, so the typical way of evaluating the fair price of a stock is price to earnings. So what's the price you're paying and what's the earnings of the business or the index, whether you look at it as at an individual company or a market aggregate like the S&P 500. And with price to earnings, there's two ways of looking at it, and it's really split about 50-50. For the price, people always use the current price, but the question is for earnings, what do you use? And one camp is to use trailing 12-month earnings. So the last 12 months, what are earnings over the last year? That's trailing earnings. Another way of doing it is looking at forward earnings. So earnings over the next 12 months based on, and you don't know what those are going to be, but you have analyst estimates. And either way, you're trying to basically get the closest number to what is the real earnings power of the business or the index. And using both trailing and forward have drawbacks. And maybe even just pausing, like, why would you look at a PE to begin with? Well, you're probably trying to make an investment decision. So using trailing earnings, a problem with doing that is if you think of a 2008 scenario where you're in a recession and markets are crashing and businesses are going under, what's happening to earnings? Earnings are declining. So if you look at a trailing PE at a market bottom in a recession, the market won't look cheap because the E has dried up. Price has gone down, but so have earnings gone down. And if you're trying to use this as a signal to tell you should you buy or sell, it's not going to work at a market bottom in a bear market. And well, that's not good because that's when you want to be buying. Looking at the forward PE, the textbook problem with using a forward PE is it's you're using humans, analyst estimates. And analysts are famously bullish at the peak of a bull market. So, it's 1999 and December 1999 and the tech bubble's about to pop. Well, analysts are all expecting earnings to keep growing. So a forward PE might actually look reasonable when in fact things turn sharply in the other direction. So that's not going to help you.
The
So
other thing, Bob, too, about your first example is I remember in 2008 or heading into the global financial crisis, people who are valuation based investors didn't necessarily see anything wrong on the horizon because they didn't realize that the earnings were about to collapse because of this, credit crisis that maybe wasn't on everybody's radar screen.
yes, that's a good point. And even adding to that, there's the profit margins can be cyclical, where companies have wide margins and tight margins. And at the peak of a bull market, you could have wide margins, and that can reverse. So the E can be cyclical. So that's a good segue to um, probably what I would consider the best valuation metric for stock indices or broad stock market, and that's the CAPE, CAPE, cyclically adjusted price to earnings. So this was developed by Professor Robert Shiller of Yale many years ago, and he won a Nobel Prize for a collection of his work, but I think it was mainly for the CAPE work. And what the CAPE is it takes the current, it's PE, price to earnings, and it takes the current price, just like the regular PEs do. So the P is the same. The difference is the E. So in Schiller's version of the PE, so the CAPE, the E is he takes the average of the last 10 years of earnings for an index and he adjusts it for inflation. So the earnings that was, 8, 9, 10 years ago, the E has grown for inflation over that time period. But what it does is it solves for the cyclicality of profit margins that I mentioned, and it also solves for the business cycle in general, so that when you look at a CAPE ratio and you're in the bottom of a bear market, well, the P is low because prices are down, but the E has not dropped that much because you're looking at 10 years worth of earnings. So when you think about buying, whether it's a stock indice or a company, you're buying it for its long-term earnings power. So why would you only look at the earnings at one point in time? And that's what both the trailing and the forward PE does, looking at just 12 months. Whereas Schiller's looking at 10 years of earnings, which smooths it out and it's less noisy than looking at the traditional PE metrics. So that's what it does. And why do people like it? The answer is because it's fairly indicative of long-term future returns for equities. It's not a great timing tool for 1 year or 3 year returns, but if you look at it and when it's when the CAPE is high, stocks tend to not do as well as over the next 10 years as when the CAPE is lower. And there's data going back over 100 years on the CAPE index. And as far as valuation tools, I think it's one of the better ones out there.
So that's what I wanted to dig into. Is it still valuable? I feel like Cape has been elevated and in the danger zone for an extensive period of time now, and I feel like even Schiller has walked back the potential use of it lately.
Yeah, it's a tricky question to answer in a few minutes, but to add some context, for the last let's see, basically since 2000, the recovery from 2009, we've lived with a CAPE above 25. And prior to this last, call it 15-year stretch, you really hadn't seen a CAPE much above 25 other than basically the year before the Great Depression and the tech bubble of the late 90s. So at any point in the last 15 years, someone could have said to you, yeah, but the Cape hasn't been this high since right before the Great Depression and the tech bubble. Not a good time to invest. And it's been a great time to invest. So that has been an issue with it. And it's continued to increase. So the Cape now is around 37.8, 37.9. So it's climbed. The challenge is, in my opinion, that we don't have a lot of data on the stock market, and it's been evolving. So while the Cape goes back to 1880, and people would be scratching their head, how do you not call that a lot of data, Bob? The stock market in 1880 was just not what it is today. I mean, to start, just think about technology. We
Bunch
didn't
of railroads or something like that.
Yes, and think about information being disseminated. Like the index funds certainly didn't exist. So it's really the wild, wild west. And if you hear academics who've been around for a while, like Professor Gene Fama talk about this, when they were teaching finance in the 50s and 60s, like, they were making things up because there was no textbook on it. So really modern finance really started around the 80s when the Bloomberg terminal became available and people could process information in bulk and then earnings were disseminated immediately to everyone. And as the depth of the market has grown, and since the 80s, we've had a couple market cycles, but it's not a lot of information really to then take a valuation and say, is a Cape at 25 cheap or expensive? And then the second layer of it is with equity evaluations, in my opinion, it's all relative. So equities, are they attractive? Well, relative to what? And the answer is bonds, relative to bonds. So what are bond yields? And for a better part of the last decade or two, bond yields were very low. So when you have low bond yields, a Cape of 25 can make more sense. As bond yields have risen and the Cape's risen, it's a harder case to make. It's a long-winded answer, but I'd say markets have been evolving, bond yields have changed, but nonetheless, valuation does matter, and the Cape is a good tool.
Valuation does matter. It's not anything that you should look at in isolation, like any kind of investment number. So you just walked us through how you help put it into context as an asset allocator by looking at where bond yields are and making it more useful or maybe normalizing it a little bit and not just looking at it in a vacuum.
That's right.
And so that is how we got to being a little bit higher in our fixed income allocation recently relative to stocks is valuations on the stock market compared to valuations and fixed income and yields elevating a little bit.
Yeah, so we look at the Cape minus bond yields, basically. You invert the Cape, so you do not the P over the E, but you do the E over the P. So basically your earnings yield on stocks, and then you subtract the yield on bonds. So on a no growth basis, what your expected return looks like. And right now, we think that if you're being tactical, it tilts towards bonds a little bit as being more attractive for the risk you're taking.
So one question I have that we didn't chat about in advance is how you think about market efficiency in the bond market, because I know that we are maybe short to intermediate term in our duration. And I think a lot of investors are concerned about owning long-term bonds. But if you believe in market efficiency, I guess, do investors believe in market efficiency in the bond market as much as they do in the stock market? And if they do, why would they be apprehensive about owning anything on the yield curve?
Yeah, it's a good question. I do think the bond market is a fairly efficient market. If you just think about it, if my job is to be a stock analyst and I'm covering Nvidia and I need to come up with a fair price for Nvidia, the assumptions that I need to determine are pretty complicated. It's basically how much money is the company going to deliver in profits to shareholders over the rest of its existence as a public company. And the layers of assumptions in that, there's a ton of room for error. That's a very complicated problem and hard to answer precisely. On the flip side, if I'm trying to um, analyze a U.S. Treasury bond, a 10-year U.S. Treasury bond, you'll want to know inflation and what premium, if any, you should get relative to inflation, and then apply a default probability, which you could just put zero, and you're done. You could do a little more than that, but the point is it's much simpler, and I don't think that you have a smarter audience, sorry, stock pickers, doing stocks than you do in bonds. Bond people are very smart. So by itself, I think investors do make the bond market pretty efficient. So why don't we just index in bonds? And the issue is when you index in stocks, the typical way stock indices are constructed is they're market cap weighted. So the biggest issuers of equity are the largest constituents. So in a stock index fund, you'll have Apple, Nvidia, Microsoft as the top holdings. They're the biggest companies. They're the biggest weights in the portfolio. That to me is pretty reasonable because they are big companies producing lots of profits. In the bond market, it doesn't make as much sense to me because the way it works is in bond indices, you have the largest issuers of debt as the top holdings and the lowest issuers as smaller holdings. And just because a company issues tons of debt doesn't mean that that they have a strong balance sheet or strong cash flows to support that debt. So I just think the construct doesn't lead to a very simple approach working. For example, if the US Treasury has a lot of 20-year debt issued. If that's on a curve that for some reason it just balloons at 20 years, then an index fund is going to have a lot of 20-year debt. And that just seems more arbitrary than embracing market efficiency. That is where the market is, but it doesn't mean that that's right for me. So with bonds, it's less about us saying we can be smarter than the bond market and more about us saying we want to pick and choose our exposures, and it's about picking and choosing the risk returns that we want to take. And the one other area that is pretty big is securitized credit. So securitized credit, it includes a lot of mortgages. So um, not agency mortgages, commercial mortgages, but also asset-backed securities like auto loans are in there. It's a pretty big market, securitized credit, and a good segment of that is not in most bond indices. So when you work with active managers, they're able to invest in that market. So to some extent, they're investing in fixed income instruments that aren't even in the index. It's more of an apples and oranges comparison as opposed to the equity equivalent hiring a manager to pick better stocks out of the S&P 500. Here, it's just weighting the index differently and adding non-benchmark constituents into the portfolio.
Great. No, I appreciate that. It was just something that occurred to me as we were going through your answer on equities, and you touched on, the other side of the portfolio there on fixed income. So, speaking of something that may not be a very efficient market, we did get a jobs report the other day that has caused a lot of angst for a variety of reasons. One of which it wasn't a great jobs report. And then the second, it had massive revisions, and so somebody else lost their job as a result of it. So maybe walk people through the jobs report. And if, by the way, as a chief investment officer dealing with individual clients, you don't think they need to care about the jobs report, you could say that too. But what did it show you? What did you take away from it?
Yes, it was. I know you opened the door to me say it's not news really, but I think it is important.
Okay.
So now, if our clients don't want to worry about us, that's why they hired us, so they don't need to worry about it. But I think it's important. So what happened? The U.S. economy added 73,000 jobs. Economists were expecting 110, so that's a decent miss, 73 versus 110. But the bigger news was that they revised the prior 2 months. So that was July. And then they revised May. May, they reported 144,000 jobs, and they said it was actually 19. So it went from 144 to 19. And then June, they went from 147 to 14. So the 3 month total new jobs was about 35,000 when they're looking for over 100 a month. So that it's a pretty big miss on the revisions, and it's pretty slow job growth over 3 months. It's the weakest if you take out the COVID period where basically the economy shut down. It's the weakest non-COVID period for job creation since 2010. So it is a sign of the labor market cooling. And look, when you think of Fed policy, they have a dual mandate. It's a strong labor market and price stability. So it's we talk about the Fed a lot in this podcast, and the market pays close attention to Fed policy. This, I think, definitely gives the Fed the green light to cut rates in September. So going out 6, 7 weeks from now, I think it's more of a question of is it going to be 25 or 50 basis points that they'll likely cut. Um, this brought the unemployment rate up to 4.2% from 4.1%. So that's still a relatively low level. I think it got down about 3.5% about 2 years ago. So it's a slight tick up in unemployment. And at first, honestly, when I saw Trump fired the guy who reported this, I did kind of cringe, but those are pretty big misses. I would be investigating at least what's going on here and how they're missing by that much. I haven't done that. That's not my job to worry about. But those are pretty major revisions, and having it for 2 months in a row is those are big misses. Not just in the data, but to say 144 and then oops, it was actually 19. I don't know what's going on behind the scenes there, but the degree that they were wrong twice, and then just the overall numbers were pretty weak.
I saw a tweet from Ray Dalio. Was one of his longer ones, although I think everything he says is fairly long-winded. And it was basically, yeah, I would have fired this person too, but the problem is, the optics of it more than anything. So there's an issue with this, but pretty sure that's not really what was the driving force behind it.
Yeah, you don't know. I won't comment on that anymore, but they did get it pretty wrong, and the number's not good.
So do you think the economy is slowing down meaningfully, Bob?
Meaningfully, it might be pushing it a little bit, but slowing down. Yeah, I think that's a fair takeaway, at least from this jobs report.
So that leads us, I think, to our final topic. I shared with you another podcast that I listen to a fair amount. It's called Trumponomics by Bloomberg. And I think they do a great job uh, just kind of getting into the topics that we're talking about, but more specifically, kind of government policy and how it interacts with the economy and the meaning behind some of these changes and things that we're seeing. And they had an episode that came out July 24th. It was, is Trump right about the Fed getting it wrong? Which I found fascinating because they had someone on who basically made the case that it isn't really the president who's playing politics with the Fed and interest rates. It's the Fed that's playing politics by seeing things that don't exist because they're not necessarily supporters of tariffs like a lot of kind of mainstream economists. And so they're ascribing negative inflationary and economic reactions to these policies that A, either don't exist, or B, are not going to persist. They'll be more kind of one-time hits. And I asked you to listen to it, and I was just curious, are you buying that argument that the politics are kind of coming from both sides, and we haven't seen any negative inflationary impact from the tariffs so far, and if we do, it'll be a one-time adjustment, and maybe it's that these folks just don't like tariffs and they can't see past that.
Yeah, it was interesting to listen to and thought-provoking. So my initial reaction was, so they're saying that tariffs will lead to a one-time shift in the price level, but then it'll flatline. And so that sounds transitory to me. So you're saying it's going
Yeah.
to be transitory. Don't worry about it.
Yeah.
The Fed tried that with COVID, and that didn't work out so well for them. So I think the issue with that argument is one that Trump himself has not even acknowledged that tariffs will lead to an increase in prices, whether it's one time or beyond that. It's been more China's going to pay for it, not there won't be a change in the price level is more what I've seen and read and heard. So that, and then the other issue is that changes in price can be sticky. So if it is indeed just a one time or a one time, so you see a one time change in the price level, so prices go up, then CPI goes up, PCE goes up, so inflation measures increase. And does that lead to wages increasing? I mean, even things like Social Security checks, they're formulaic. They should increase. So now Social Security checks are larger. People, who get a COLA increase that might be tied to inflation, they get paid more. And do they spend more? So you can see how it's not as simple as, oh, it'll just go up a few percent, but then it flatlines. And then the other thing is it's hard for the Fed because they have this dual mandate. Their way of measuring price stability is looking at inflation indicators like CPI and PCE. And if it's expected that this is going to lead to an increase, to ask them, we'll just ignore it because it's from tariffs and tariffs don't cause inflation. It's like that's their thermometer for inflation, and you're making the room hot, and you're just asking them to ignore the gauge for a little while. That's hard to do.
Yeah, I mean, I guess you're asking them not to see things that haven't happened yet, right? So if they're supposed to be data dependent and these things haven't filtered through to prices, and we have seen some headlines of companies absorbing some of the cost or shifting them around. I think the point of the podcast that resonated with me, it was like, well, we think what you're doing is going to lead to this. So we're not going to be data dependent. We're going to be dependent on our viewpoint of
Yeah.
expectations on what's coming down the pike. And I thought I would highly recommend it to people just trying to get a sense of, the other side of some of these arguments. And it was interesting. Yeah.
Yeah, no, I agree with that, and I also think the other side of it too, where I think Trump might have a better case is, and it does challenge Fed independence, but with the amount of U.S. debt that the country has, the rate that the Fed sets, if the U.S. had no debt, the Fed funds rate would be a great tool. So you're changing the cost of mortgages, changing the cost on businesses to borrow money, and that's very effective. But when the largest issuer of debt is the US, it's hard for the Fed to be independent of that and just not factor in that a 1% change in the Fed funds rate, if you account for debt rolling over at that new rate, is in the billions of dollars of interest expense over time. So it is very meaningful. And should that be considered, while I do think the Fed should be independent, not just do what, say, the president wants them to do, should they do a little more than just every time they're in Congress say, hey, you guys are on an unsustainable path, and then back to regularly scheduled programming, which is earmuffs on the debt and deficit? Or should that somehow factor in? Um, that I'd be more open to as well.
So, regardless of that, I wouldn't say it was an esoteric debate, but it was more esoteric than we usually get. We are expecting both rate cuts in September. And I think prior to this jobs report, that wasn't the expectation. And so, we're going in the direction that a lot of people want because of that report.
That's right.
All right. Well, Bob, thank you for your time. I appreciate it as always, and look forward to chatting next month and seeing where things are.
Sounds good. Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.